We're excited to kick off the day with the International Value Team. So I'm here to introduce the team. Last year, when I introduced David, my specific comment was David's unwavering commitment and passion to fundamental and value investing is alive and well. There's been no change, obviously. When you look at what they've been able to achieve over the years since, David's performance speaks for itself, so it's just a long continuation. I really want to turn it over to the team, but we've heard a lot about interest rates and inflation. We've heard a lot about growth versus value. I think the one thing that I always like to talk about with David is throughout all of this, he's always been focused on long-term value investing. It doesn't really matter what the flavor or the trend is that people are talking about. He remains committed and dedicated to honing his craft of excellence. And it's all with the mindset of building the best and most successful investment platform where he can produce absolute returns on behalf of not only his clients, but his team, his family, everyone that are investors. And I think that that's a testament to what David does. He always looks through the smoke and focuses on what he can predict, which is business quality and valuation. Having been in the manager selection business for over 20 years prior to joining Artisan, I can say that there are unique investors out there, and David is certainly one of them. But what makes David even more unique is when you think about what he's been able to achieve beyond just his track record. If you look at the franchise that he's been able to build, if you look at the team that he's been able to develop, those are characteristics not typically associated with strong portfolio managers. Usually they're very good at managing portfolios, but not necessarily very good at managing teams and businesses. David's been able to do it all over the last 22 years at Artisan Partners, and I think that that is truly an outstanding achievement. When you look at the team, though, the one thing that you'll find is that he has an unwavering commitment to not only value investing, but to identifying those people that have that same belief system and enculturating those people into his team. And you're going to get to witness and experience 3 of these individuals today. You will find that they are all very much aligned to how they think about the fundamental world of value investing. And so we're excited to hear from the team today. When you look at the stocks that David and the team are going to be talking about, there are 5 different companies. What you'll find is that nothing really is in common with these companies. And why is that interesting? Well, there's one thing in common. The one thing is they've all been in the portfolio over decades. Some that have been in the portfolio since inception, a few that have been in there over 10 years, and one that's been in and out of the portfolio over the last several decades. And so I think that's a commitment to really what he has espoused over his entire career, which is being long-term value investors and really just focusing on what he can predict, which is, again, that business quality and the fundamental value underlying those businesses. When you think about the commonality in each of these businesses as well is, number one, they've been really brought through the exact same process that David's developed and built over 20 years. So that is a huge commitment. But what's important about that process is when you think about a value investor, they typically have some kind of a cyclical element to their process or very focused element. It's usually, I'm going to buy cyclical industrial businesses, I'm overweight financials, I'm overweight staples. But David's platform is developed to be very structured in what he looks for, but the aperture that he uses to identify companies is wide open. And I think that that is a very unique and opportunistic way of identifying value businesses that he can put into the portfolio. The one other characteristic that I would say about these 5 companies is they represent about 22% of the overall weight in the portfolio as of March 31st. I mean, how many times have you heard an investor come, they pound the table and they say, this is a great business, and you look inside the portfolio and it's a 75 basis point weight. That's not what David and the team do. They put punching power behind all of their positions. They really enforce their behavior by making sure that they have their best ideas at the top of the portfolio. And you're going to get to hear about 5 of them today. And so I'd like to turn it over to David. David's going to give some prepared comments. We're going to get the exposure to the rest of the team. And we're looking forward to a really robust couple hours with the team on value investing. Thanks, David.
Wonderful. Thank you. Thank you, Jason. That was a very kind introduction. Before we get going, I'd like to throw out a couple of thank yous. First to you, our clients. We take our responsibility for investing your capital and our own capital and my family and their family's capital very seriously. We know that your capital, along with ours, allows us to gain a certain amount of scale, so I can bring in people that we have up here on the stage. And I appreciate the long-term commitment that many of you here in this room have made to us. And there are certain people that I know in this room where they're on their third generation within their family that have ownership of the Artisan International Value Strategy, and we appreciate that level of commitment. So thank you all very much for that. And second, I actually want to thank Eileen Kwai, because I find that this event this year is the best event that we've ever had, and her organization skills are amazing, and this event has gone very well and is very effective, and I think it works for both us up here and for you, our clients. So thank you. Okay, so who do we have up here? So Ian McGonigal, here to my right, helps me out managing the portfolio, and what that means for us is we have basically an analytical role, as Jason referred to it, and we 100% focus on looking at businesses and deciding whether or not we can compound wealth by acquiring a small piece of ownership in this business at a price that's very attractive. And that is a very complex process. I'm going to put our philosophy slide up in a minute, and I'm going to show you the characteristics that we look for in a business. And those characteristics, most of them are pretty easy to identify. Good business, strong balance sheet with a great management team. And people talk about that all the time. Oh, look at NVIDIA, it's such a great business. But the real question behind any investment that you're making is what is it worth? And then what you have to pay for it relative to what it's worth. And that's the complexity behind what we do. That's where we spend almost all of our time. And it's not a single person's job in our view. So if Joe comes across a company and he's interested in it, we have a process internally where we're talking to Joe every week about what he's learned about that business and what are the next steps necessary to learn all of the incremental information that's required for us to try and truly and deeply understand within a realm of reason what is this business really worth. And that is quote unquote an oversight process, but it's a collaborative process that we go through to ensure that Joe gets the benefit of our experience, Joe gets the benefit of a second set of eyes, in this case 3 sets of eyes going over the same material, and we get the benefit of making sure that we have a very, very deep understanding of all the securities that end up in the portfolio. So Ian, as his job as quote unquote portfolio manager, which is not in our sense, a traditionally thought of role. He is integral to pushing along that oversight process. To my left is Joe Vari. Joe has been covering Asia for us since 2012. So a very long time. He's been the architect of many of our largest positions in the portfolio, and today's largest position, Samsung. And so he is going to bring you through the detail of what is an incredibly large, complex, and intricate company from many, many different dimensions, and that has cascaded through his career and some of the equities that he's brought to us in the portfolio. And on my right, at the end of the table, is the incomparable Charlie Page, who came to us from Marty Whitman's shop in what year? 2017. And Charlie, I have a special place in my heart for Charlie because, as a value investor, you always have this tug between, I want to own something that's seriously undervalued, and usually that comes with some ugliness associated with it. But on the other hand, you also want to own great businesses, which is, really how we compound a lot of wealth. And, Charlie loves, the down and dirty companies. And so I have a special place in my heart for Charlie, willing to wade into the swamp, so to speak, and take a look at things that are incredibly messy. And, that has resulted in several securities in the portfolio that have compounded. One of the best things in the world is you find a company that's commonly believed to be, horrible, and it's sort of like the ugly duckling thing, and then it turns into a beautiful business, and the valuation just changes dramatically. And we're going to talk about a couple of those today. So this is only part of our team, but this team is very experienced, has a lot of an amazing amount of cumulative knowledge build about the companies and businesses and people and macroeconomic and political inputs that go into the decision-making process. And on top of that, and Jason talked about this a little bit, they're value investors. It takes I can't remember who made this quote. Maybe you remember Ian, but it takes a certain type of person to run towards a fire, right? And most people run away from fires and head towards something that's more peaceful and interesting. But value investors are just wired in a different way. And, we run towards fires, and that's very, very productive in the world of value investing, because the stock market is, part economics and part psychology, and we effectively make our living by taking advantage of people's weaknesses when it comes to their own money, in the consistency of mistakes that they make in the stock market when they're making decisions around their money. And you need a certain breed, and all of these fellows are of that breed. And when you put that on top of years and years of experience, it's very, very hard to rival that. So please, let's have a round of applause for Ian, Joe, and Charlie. Okay, the agenda for today. So first you've got, we've got this Unilever product on your table, Liquid IV, which I always thought, as a runner, that this was, to rehydrate like Gatorade. And my assistant informed me that this is really for people with hangovers who want to, rehydrate the next day. But, and then, so this is a Unilever product, and we're going to talk about Unilever today. And Stock is a coffee brand that's actually sold by Danone. And you don't have this on your table because we couldn't get enough of it. But it is delicious, and I do recommend that you try it. And then, of course, we have Evian, which is also a Danone product, which we're not going to talk about today. But they've made a concerted effort with their water to try and displace Nestle in that business. And I think you'll find it at more and more restaurants. And please help yourself. But so what we're going to do today is we're going to take a very brief look at the philosophy and process that we use. And then we're going to have a detailed discussion of 5 of our larger investments in the portfolio. And then we're going to open it up for Q&A. Okay, here's our investment philosophy. And really, what we're focusing on here is the 4 key characteristics that we look for in an investment in a business that we want to own. We're value investors. It goes without saying. The security has to be undervalued. We're not interested in anything that looks like it's trading at some sort of fair price. And we're reliant on the underlying growth in the value of the business in order to drive our returns. We are definitely looking for good businesses, and that's why that actually do grow over time. But we don't want to pay a fair price for that. Why? Because if you look at the empirical studies, it will show you that value investing works over time. It both allows you to generate excess returns, and it allows you to manage your risk. And so buying a security at a big discount to what it is worth is the reason that value investing works. We also look for financial strength. We find that companies that have strong balance sheets are able to not only withstand any adversity that comes their way or properly reinvest back in the business, but also if you get this 4th characteristic right, which is a hard one, and Joe's going to talk a little bit about that today, on the management team. And if you have a great management team running a good business and they have a balance sheet and they can reinvest some excess capital, you can drive returns at a rate that you just can't put that in a spreadsheet. And that's been part of the magic formula. And we're gonna see that when we talk about Arch Capital today as well. That's part of the magic formula that's driven our return over time. So that's our basic investment philosophy. Almost all of you have heard me speak about this, and I would have said the same thing in 2002 that I'm saying here in 2024. So nothing's really changed. And I sort of struggled as whether or not I wanted to bring this in. But really, if you look at the details of this slide, what you're going to see on this slide is really how we work. And since I have some of the team here at the table, it will give you some sense for the dialogue that's going on between us in the office. And it all starts with idea generation, sourcing, trying to find things to work on. And so, we have qualitative things that we don't like, where we don't have a vote. We're not really that interested. Where we don't have any protections for us as minority shareholders, we're really not that interested. And then we start looking for things that we do like. Companies that are statistically cheap, companies that have great returns, companies that are losing money today, but that might be temporary. Like we just try to screen out, the market to find something, that might be interesting for us to do all the heavy lifting on. We also do other searches. We look for companies with profit warnings. This whole thing that the broker dealers have set up, where we all read the paper and they go, oh, the company beat the estimate, right? And you're thinking, wait, but their revenue went down. So how could that be good, right? And it's just this whole system that the broker dealers have set up to drive trading volumes, and it's permeated media in a way where it seems like it's some relevant piece of information that a company missed or a company beat estimate, but it's completely irrelevant. It has nothing to do with the quality of the business or what's happening with the company or whether or not it'll be more valuable or less valuable in 5 or 10 years. It's just a mechanism for the broker-dealers to affect more transactions, and all of us sort of get sucked into that. But the reality is if a company misses or there's a profit warning of some sort, the share price tends to react very negatively, and it creates an opportunity for people like us to go in and maybe find something interesting to do with our capital. And there are other things that we look for, spin-offs and restructurings and other disenfranchised shareholders. And this is what we talk about. Every week we have a research meeting, and we talk about all of these things. And we have specific screens and searches that we do in order to find things. But the most valuable way that we find ideas is from what I referred to earlier, which is cumulative knowledge. And that means just getting out on the road. We have one of our newer analysts here in the crowd today, and as he came on and he was trying to figure out what we do around here, which is kind of quirky, I said, you shouldn't try to figure it out. You should just get on the road and go visit as many companies as you can, and you should find investments that you yourself would put a significant portion of your own family's capital in. And that's the bottom line. You just got to get out there, and you got to find businesses, and you got to know businesses. And once you start to do that over a course of many, many, many years, and you're going to the same countries and looking at the same companies over and over and over again, you start to figure out what are the good companies and what are the bad companies, and which ones are run well and which ones are not run well, and which ones are cheap and which ones are not cheap. And that's extremely valuable information and is the most productive way that we find new ideas. And then we work on them together. We build all our own financial models. We don't use databases like, all these new AI programs that are out there, and they're gathering information from here, there, and everywhere, but we have no idea where that information is coming from. They give you a feed and they say, oh, this is what you should know about this company. Well, where did you get that information? Where did it come from? Was that from a source document? What document? Does that actually come from? So we get all the firsthand information. We get all the source documents, the audited financial statements, and we analyze it ourselves. And we generate our own look at what historically the economics of the businesses are. And then we use Bainey and Anand's things from yesterday, the scratch and sniff, which I have to review their presentations next time before they come to an event like this. But we go out and we talk to companies, we talk to competitors, which is and we talk to anybody who can help us really understand that business. And we start to, through that process, start to form an estimate of what we think it's worth. And we'll only engage if there's a serious discount to intrinsic value. So that's that slide. And okay, so this is kind of a victory lap slide, which I'm a little embarrassed about. But I had asked Haramaya, who's in the back of the room here, last year to check on our performance versus the S&P 500, because why would my mother give me money when she could just stick it in the S&P 500? So I wanted to know, how do we stack up? And intuitively, you say, it's fascinating. If you look at those lines that are bumping along the bottom there, right? That's, Ian, what does that say over there? Is that MSCI? Yeah, my eyes are going.
Japan is at the very bottom.
Okay, so Japan's at the very bottom. And then I think we got Europe. And the overall EFA index, which most of you use as our benchmark. Thank you. That's what I'll say first. It's like a hurdle runner jumping over 2 inches, And so, the point is international markets are an interesting place to invest, but you wouldn't expect somebody who's investing in that sorry story, to be able to even compete with an index that is filled with Google, Amazon, Microsoft, Tesla, NVIDIA, who, can you forget about that one? Probably all of you own it. Somehow I'm the only one on earth who doesn't own it. You would expect, somebody who's stuck not investing in those things to be woefully underperforming them. And so it was to my mother's delight that I had actually done her a favor rather than her being charitable to her son. It says a lot about, and the reason why I'm putting this up here, it says a lot about what we do. And, oh, I had actually written some notes on this. We don't want to give you exposure because, well, you can see what exposure looks like. And it doesn't make any sense to us. Those indexes are filled with crummy businesses, and most of the time they're at a fair price. And who wants to own a crummy business at a fair price? The United States has a lot of distinct advantages, and I think Dan O'Keefe went over most of them yesterday. Hopefully you caught his presentation, which was fantastic. And I don't agree 100% with everything that he said, but probably 95% of everything that he said. But the wonderful thing about investing outside the U.S. is that all of that sad, all of those sad results make people averse to doing it, and it's complicated, right? They're not awake when we're awake, and they don't speak the same language that we speak, and they don't operate in the same currency, and probably maybe one or two of the companies that we're going to talk about today you probably never even heard of, and that's probably, if you go through the portfolio, you probably never heard. So what we do is pretty exotic, and then if you start to layer on different cultures, different corporate governance, different currencies, some are overvalued, some are undervalued, different political structures, different maturity of all of these things. The world of investing outside the United States is very complicated, but complexity provides opportunity. And if you approach that opportunity with an attitude that you're not trying to gain exposure, but you're trying to generate wealth, right? You can end up with a result like this. And I oftentimes give the example of a friend of mine who runs a financial services hedge fund, and I can't think of a more horrible industry to devote your lifetime to. But his numbers are off the charts, and the reason is he's not interested in exposure. He's interested in creating wealth, and he's very good at creating wealth. He has an absolute orientation to what he does. And I'm 100% happy having all of my money in this, despite not having much exposure at all to the US securities market. Why? Because I'm doing the same thing that a US investor would do. I'm trying to generate purchasing power, more purchasing power in the future than we have today. So then my pitch to you today is, don't think of us as international exposure. Think of us as money managers who are trying to generate wealth for you, our clients. That's completely different than what I wrote here. So when people ask me, what are you exposed to? Oh, you're overweight this or underweight that. I go, no, this is what we're exposed. Here, 10 companies here. This 40% of your money is. I go through client meetings where nobody even asks me a question about a company, and we don't go through a day where we talk about exposure to a market. It doesn't even come up in conversation. Like there's a huge gap between what we do all day and oftentimes the way that clients think about what we do all day. And so where does that magic come from? Where does that come from? Well, this is where it comes from, and maybe we're going to get some of these wrong, and hopefully we're doing most of this right. But we spend all of our time trying to figure out where are these, what is the value of this business? Truly, what are the value of these businesses, and can they generate wealth for us in the future? Not can they do better than a crummy index. I don't care about that index. And it's a good thing that I don't care about that index. So what better way to have a dialogue with you, our clients, than to talk about some of these companies? So that's what we decided to do today. Joe's the guinea pig. And for a reason, Samsung is our largest position. And we've been a shareholder for a decade, roughly, of Samsung. And it's our second time being a shareholder of Samsung. So we've known this company for many years. And with that, I'll hand it over to Joe. And he's going to talk for a long time. And we're all going to talk for a long time. And it's going to be a fair amount of tedious detail about these companies. But I think what it will do is it will help you gain insights into the way that we think about the world and the way that we invest. And it'll either make you very comfortable with what we're doing or very uncomfortable with what you're doing. If I see you leave, I'll expect a big redemption tomorrow, which is okay because we want everybody, sort of thinking the same way that we do if they're coming with us on this journey. So with that, I'll hand it over to Joe.
Hi, thanks for coming, and I'm here to talk about Samsung. We still believe that Samsung remains one of the most attractively valued, operationally and financially strong large companies in the world. It's very attractively valued at an EV to EBIT of around 7 times our normalized earnings and 11 times normalized net income. This is why it's the largest position. There are 2 main businesses in Samsung. First is mobile, and Samsung and Apple have been leaders in the mobile market for a long time with strong profitability and strong returns. Samsung's semiconductor business, its other key business, is a key enabler of increased technology intensity and data consumption for consumers and industries, whether it be through artificial intelligence, the Internet of Things, the electrification of vehicles. This should allow the business to continue and grow and generate attractive returns for shareholders. I read something yesterday. NVIDIA reported, as I'm sure most of you are aware, and Jensen Huang.
You've got side notes.
Well, this is a pretty bold statement, so I thought I will enlist Jensen Huang to my cause. So this is what he said. He said, "The new industrial revolution has begun, producing a new commodity, artificial intelligence, that will bring productivity, efficiency, while expanding revenue opportunities." That's a pretty strong statement, a new industrial revolution. And I can confidently say that
it all needs to be stored somewhere.
Yes,
right?
And so you are not going to have that new industrial revolution without Samsung. I thought that was a strong statement. Let me go over the history of the company a little bit, just to give you some context. It's one of the largest companies in the world, makes up 20% of Korean GDP. Just think about that, 20% of GDP of one of the larger economies in the world. Has one of the most recognizable brands in the world, and obviously its products are sold across the globe. Market cap's around 350 billion. They employ around 300,000 people in 80 countries. We think about the business in terms of normalized profitability, and that happened last in 2022. And at that time, Samsung ranked number 18 amongst the global 500 with $235 billion in revenue, right behind Google, and number 14 in net income with $34 billion in net income. It was established in 1969 to actually manufacture TVs. The founding chairman, K.H. Lee, believed that the semiconductors represented the future of the group. He created a culture that was focused on manufacturing discipline, product design, and efficiency, leading to both technology and market share leadership. He passed away in 2020, and his son became executive chairman in 2022. The Lee family owns 5% of Samsung Electronics, but also exerts further control through ownership stakes in Samsung C&T, Samsung Life, which in turn have holdings in Samsung Electronics. The business itself can be divided into 2 buckets. The first is devices, mainly mobile phones and consumer electronics. They make up roughly 30% of profitability, which comes mostly from the mobile phone business. Samsung is the global market share leader in mobile phones, 22% market share, followed closely by Apple at 21%. These businesses are designed and brand focused with certain critical technology components and are sold to consumers. The other business, we can call it components, is mainly semiconductor, which in turn is mainly made up of memory. And within memory, there are two kinds of memory. There's DRAM and NAND, I'll talk about a little more, make up about 55% of components. LSI and foundry, which is manufacturing chips, about 7%. And display, Samsung is the market leader in displays. That contributes about 14% of EBIT. So this components business is the other 70% of profitability. It is different from the devices business because it's highly capital and R&D intensive, and the end customers are not consumers, but other technology companies such as Apple, AMD, Intel, NVIDIA, Microsoft, and even Samsung itself. So memory is normally around 55% of profitability and grows with increased data consumption of any kind, including AI. And in memory, Samsung is the market share leader in DRAM with about 45% market share, and Hynix and Micron are the only two other manufacturers of DRAM and split the remaining market about evenly. NAND, which is a storage, which is storage of computing, is storage for many of your devices, flash memory drives. Samsung has about 32% market share. And the second player has about similar market share to Samsung. It's Kyocera in Japan. Hynix has 18% and Micron has 4%. Now, these market shares have been pretty stable over time. I know, recently Hynix has taken market share with something called HBM. I will get to that. But DRAM has higher technology complexity. It's basically enables the processing power for the brains of devices. So the CPU in your desktop, GPUs in servers. NAND is a form of storage memory that does not require power to retain data. So it's you can think of it as a more efficient and sophisticated replacement for magnetic storage such as HDDs and USB flash drives. Now, what's unique about Samsung is this vertical integration between devices and components. And I think it gives them a competitive advantage. For example, Apple relies on Samsung for its displays. Apple doesn't have a foldable screen. Samsung does. And that comes from this vertical integration. Why is this a good business? So this is a good business because it can grow and generate high returns on capital over time. Samsung has grown both revenues and EBIT at a CAGR of 4% over the last decade. Just as importantly, Samsung has earned an average return on invested capital of around 23% over that same time period. I think Ian is going to talk about Unilever, and they do something similar. And they both deploy large amounts of incremental capital while earning high incremental returns through the cycle. And just to give you an idea of the scale, CapEx over the last 5 years at Samsung has averaged $43 billion. R&D has averaged $23 billion. Hynix and Micron together, their CapEx has averaged about $20 billion, so less than half of Samsung. And I would say their R&D is also less than half of Samsung. So because of this, Samsung, over long periods of time, has maintained a technology lead versus its competitors in terms of manufacturing, cost leadership, which is critical in semiconductor manufacturing. And that allows it to maintain or grow its market share in each of its key businesses. Also, Samsung is a technology company and serves end markets that are cyclical and fast evolving. So Samsung's financial strength, where they have about $60 billion in net cash, enables it to prevail and invest during down cycles and fund new businesses such as foundry, which require a lot of upfront capital investment. And while Samsung is a distant second to TSMC, it is the second largest foundry business in the world. And so both its competitors have substantial amounts of debt. Both its competitors cut CapEx by 50% last year. Samsung maintained CapEx. So that shows you that they are able, because of their financial strength, they are able to invest when others are not. Why have we been able to buy this business at an attractive price? It serves cyclical end markets. And due to increased data consumption, memory is a secular growth market, but it remains highly cyclical. The whole industry lost record amounts of money in memory in 2023. To give you an idea, Samsung's EBIT went from $43 billion in 2022 to $6 billion last year. That's why we value the business based on normalized earnings. Mr. Market takes a different approach. And therefore, during our piece of ownership, we generally have taken advantage of this volatility to increase and reduce our position based on our estimate of intrinsic value. Samsung has faltered since the founding chairman passed away. J.Y. Lee, his son, has been distracted due to an outstanding court case following a bribery scandal under a previous president. Welcome to Korea. Coinciding with this, the previous management of the semiconductor business prioritized sales and short-term market share over technology leadership. So this had an impact on technology leadership and the culture of the organization. Samsung is also listed in the Korean market, and the Korean market has always traded at a large discount to other markets due to concerns over corporate governance and shareholder returns. The largest companies in Korea operate under a conglomerate structure called chaebols. I mentioned earlier the circular ownership in Samsung from its affiliate chaebol companies. And chaebols are plagued by circular ownership that enables founding families to maintain control with a small ownership stake in the company. There have been instances where the founding family purposely depresses the stock price to avoid high inheritance taxes. And Korea has some of the highest inheritance taxes in the world at 60%. And they have poor regulations against corporate governance. Incredibly, under the Korean commercial law, the board of directors does not have a fiduciary right to protect shareholders, which is, shocking.
To say the least.
To say the least. So how will things change? After the recent downturn in 2023, it's hard to argue, as Micron did in the past, that the industry had become less cyclical with consolidation over the previous decade where, they're basically Samsung, Micron, and Hynix and DRAM. Well, the industry lost more money in 2023 than it's ever lost, even before consolidation. And so we believe memory will remain a cyclical industry. But the key for us is that value creation through attractive growth and returns remain intact through the cycle, as evidenced by stable market share and industry structure. This is what we underwrite. This is what we spend our time constantly reevaluating. Because that results in growth and returns, which results in our capital compounding at attractive rates. So right now, Samsung is paying the price for losing technology leadership with something called HBM, high bandwidth memory. You can think of it as supercharged DRAM, needed to power AI data centers. HBM supply is sold out for this year, and the product commands high ASPs and profitability relative to standard DRAM. So HBM is probably 4 to 5 times the ASP of standard DRAM, and therefore the margins are much higher. David and me met with the semiconductor business CEO last March. He became CEO in 2022. He just got fired 2 days ago. He told us that the culture of the company had become restrained and dictatorial and focused on short-term targets prior to him taking over. The technology gap with the competition had narrowed. This was because the culture became oppressive and engineers were being told what to do rather than have freedom for development. This cannot be fixed overnight. He created a new technology roadmap, improved communication vertically and across the organization, but it takes time to change all of this. At the time, he estimated it would take 3 years. And they made the decision to steadily invest through the downturn because they believe that this results in lower costs and higher returns. And as I mentioned to you, last year, Hynix and Micron cut CapEx by 50%. Samsung's CapEx was flat year over year. And what they've done and where they've invested is they mainly invested in fabs. And you can think of fabs as manufacturing shells for semiconductors. And so what that ensures is because the competitors cut capital spending by half, when the cycle recovers, as it seems to be happening now, Samsung will be the only supplier with enough capacity to meet demand under a normal industry recovery. Hopefully, we get better than a normal industry recovery with all the things that are happening in AI. A few weeks ago, I was in Korea. I actually got the chance to sit down with this guy again, and with a small group. And he acknowledged that Samsung had fallen behind Hynix and HBM. But he expressed confidence that Samsung would regain market leadership in the next iteration of HBM. This is called HBM3E, 12 high. I know that's a complicated acronym, but it's just a more powerful and efficient form of the previous form of HBM. It's going to become the industry standard by the end of the year. And Samsung's market share will start increasing starting in the second half of this year and continuing into 2027. I'm sure you read a few days ago, as I mentioned, that this CEO, his last name is Kim. There are a lot of Kims in Korea, but was replaced as CEO of the semiconductor business the day before yesterday. This is unusual at Samsung because they usually make management changes at the end of the year. So making this management change in the middle of the year is highly unusual. And I think this was because of their loss of technology leadership in HBM. His replacement used to be head of the memory business from 2014 to 2017. 2017 and 2018 were the previous peaks in the memory business. And he then left and became CEO of Samsung SDI, which is one of the leading EV battery suppliers. And so we'll see. He also has the title of vice chairman, which is different from the previous CEO. And he's actually, nurtured and grew SDI, which is a relatively new company. So we'll see. It's too early to know how things will play out under him, but this change was just announced. The other business, which is Samsung's largest growth opportunity, is the foundry business. Now, this is a large addressable end market, but again requires heavy capital investments. But it's less cyclical than memory. So you can look at TSMC. Their estimate of non-memory semiconductor growth is about 5%, and they grow at much faster rates than that. And the foundry industry essentially manufactures chips for outside customers, such as fabless chip designers, such as Qualcomm, Broadcom, NVIDIA, Apple, et cetera. And TSMC has an excellent track record of growth and returns. Currently, TSMC's market share is around 55%. Samsung's is about 15%, UMC about 7%, and SMIC, a small company in China, has about 5% market share. But there's only two people that can manufacture chips at the leading edge, and that's Samsung and TSMC. And again, that requires massive capital investment and technical expertise, which represent formidable barriers to entry. So this is a large opportunity, but it's still early days. You need high capacity utilization to have high levels of profitability in the foundry business, and that requires a large and diverse customer base. And Samsung is behind TSMC on that front, but does match them in terms of technology. It was growing the foundry business double digits prior to 2023, did about $15 billion in revenues, with a double-digit operating margin. The goal was to reach free cash flow break-even in 2025 with a 20% operating margin. That's been pushed out. But the only reason I bring this up is because it remains Samsung's largest growth opportunity. I'm sure you've read a lot of headlines about what's happened in Japan in terms of corporate governance. The Korean government recently launched something called the Value Up program to narrow the discount versus other markets. One of the reasons they did this is there are now about 15 million retail investors in Korea, which is about 30% of the population. So they have to now pay attention to capital markets. Unfortunately, in the recent parliamentary election, the ruling party lost its majority. But it seems that there is a consensus for improvement, and that incentives for corporate governance reform need to continue to improve. Activism in the Korean market has also gone up in recent years. Lastly, I'll just talk about capital deployment. Samsung has a shareholder return plan which ran from 2021 to 2023, and even before that, which called for a return of 50% of free cash flow to shareholders through dividends and buybacks. A new shareholder plan should be announced soon.
Thank you, Joe. I guess, there's a couple observations there. And so first, that's an awful lot of detail. And I think it's important for you to understand that the complexity associated with investing in these large companies is significant. I think the second thing to understand is making that sort of volume of information fun is really hard. And by the way, he hasn't even scratched the surface, right? Because Joe just went through Samsung, right? And in addition to their direct competitors, Micron and Hynix, you also have to understand Apple. You have to understand Google, because Google provides the operating system for Samsung's phones, right? And phones generate for Samsung $10 billion a year with the free cash flow, which helps fund the significant capital spending. And then you have to understand their customers, the end use, handset manufacturers, computer manufacturers, and then the cloud companies that are called hyperscalers. So that's Amazon and Microsoft, and this whole process of NVIDIA selling these chips, which is driving that entire ecosystem. And then the other complexity, and Joe alluded to a lot of this, is understanding the country specifics and the dynamics behind the people that run this company and what the cultural influences are on them. So it's incredibly complicated to keep on top of this and understand it. And Joe did a good job of going through all the negatives, right? We want to lay them all out there for you to hear and for you to understand, because you don't get a good deal on a great business if there's nothing wrong with it. And if I were you, I would have 100 questions by now. Why are you involved with this, or why are you involved with that? And what we're going to tell you is that the company has $200 billion worth of net cash that Joe didn't talk about, and the valuation is absurdly cheap. So every time that they sort of dismantle one of these issues that they're dealing with, and that adds value to the business, we benefit as shareholders. I'm going to go through Arch Capital in a little bit more speed, and I've asked Ian and Charlie to sort of speed up their presentations as we go through this because you're probably getting bored. I'm going to take a little bit of back in history to a very sad period in the history of New York City back in September 11th of 2001, in which the insurance industry recorded, in today's dollars, $59 billion loss. It was one of the largest losses ever incurred in history. And as a result, and that loss incurred after a prolonged period of insurance prices going down. And as a result, insurance prices started to rise, and that spurred the creation of a number of insurance companies, which were called the class of 2001. And Arch Capital was one of those companies. And two executives were the key to founding that company. One's name is Dinos Iordanou, who is the CEO. He's now retired. He was previously at Zurich and, more importantly, at Berkshire Hathaway. But perhaps the most impactful person who helped found that company was a fellow named Paul Ingrey. And Paul, prior to joining Arch, had led a remarkable track record of insurance underwriting reinsurance underwriting at a company called USF&G. USF&G was bought at the time by St. Paul Insurance, which is no longer around. And many of the successful executives that worked at USF&G dispersed out to other companies. And upon the formation of Arch, Paul called them up and brought them back in. And to this day, the company lives off of that culture and that legacy. In fact, the current CEO, Mark Grandison, worked for Paul back at USF&G, and then he left and went to work for Ajit Jain at Berkshire Hathaway, which is one of the most successful insurance companies in the world. Mark joined Arch upon the company's formation and became the CEO in 2018 when Dinos retired. Another exceptional aspect of Arch, so we have this incredible culture of performance, but we also have a unique compensation scheme. Insurance is a very strange thing where, if Joe's a customer and I'm an insurance company, Joe hands me his cash and I hand him a piece of paper. If Joe has a loss in the future, I promise to pick up that cost. But I don't really know what that loss is going to be. I have to make a guess. And I hire these actuaries to help me out, and I make a guess, and I put it out there in my P&L, and I calculate, my profit for the year. And most insurance companies will pay their executives based on that year's results, which is completely absurd because, of course, that executive is deciding, what they're going to report and then exactly what they themselves are going to be paid. Now, Arch, at its formation, actually changed that game and pays their underwriters based on what they call ultimate. So when that ultimate loss happens, which could be anywhere between a year and a half and 15 years, then they decide how their underwriters are going to be paid. So they have a hurdle rate of 15% ROE in every piece of business that they write. And to the extent that, that underwriter earns more than 15%, they get paid a bigger multiple of their compensation, and anything below 15% ROE, they don't make much money at all, right? And so the incentives are clearly aligned for those underwriters to earn an underwriting profit. There are no other insurance companies out there in the market that have been able to pull this off other than Berkshire Hathaway that I know of. Now, Arch has a third competitor. So we have culture, we have a unique compensation system, and the final competitive advantage is that Arch was actually formed in Bermuda. And Bermuda is not only a friendly place to have an insurance company from a regulatory standpoint, but also has well, now they have a low tax rate, but basically very low tax rate. And remember, insurance is a commodity. When you want to insure your car, you don't really care who the insurance company is as long as they're financially solid. But you just want the lowest price. Nobody gets excited about, hey, you know, I bought this great insurance policy. So it's a commodity, and if one of your largest costs as a provider of that commodity is taxes, if you have a lower tax rate, then you have a distinct competitive advantage. It allows you to generate a higher ROE. Insurance is a fragmented industry. The global insurance premiums are about $7.1 trillion according to Swiss Re, and Arch is considered a mid-sized insurance company, writes $15 billion worth of premiums. So Berkshire Hathaway is a larger company. They made $85 billion worth of premiums. So you can see how fragmented the marketplace is. And there's also concentrated distribution in the market through insurance brokers. And you have these sort of misaligned incentives created by this self-graded exam, which allows, if you're a talented underwriting organization, for you to participate in the market when prices are right and for you to withdraw from the market when prices are wrong. And that, Arch calls that cycle management. You know, they want to put more money and take in more premium when ROEs are high and take in less premium and allocate less capital when premiums are unattractive. And so they have clear focus and aligned incentives on generating returns and growing book value, plus a very low tax rate, which is a powerful driver of return. The company operates in 3 segments: insurance, reinsurance, and mortgage insurance, which was a great acquisition that they made from AIG several years ago. And they cycle manage between those 3 areas, but it sort of understates their ability to do that, because even within each of those businesses, they have different lines of business like property catastrophe, general liability, marine aviation, et cetera. And each of those lines have their own cycles. And generally speaking, the demand for insurance goes up over time, right? So if you think about, you know, the value of your house as it goes up over time, or, you know, the average cost of a car as it goes up over time, or other types of property due to general inflation, it's going to cost you more and more money to insure that property. But the cycle comes from, you know, participants in the market getting over-enthused or frightened. It's like the stock market. There's a big psychological aspect to actually companies participating or not participating in the insurance market, and that's what causes these cycles. And there's one more aspect of insurance that's really important to understand. Remember, in our basic transaction, Joe hands his cash over to me, and I get to keep it. And I can sometimes keep it for a long time before the ultimate claim is settled. And in the meantime, I invest that cash, and I get to earn a return on that money. And so, you know, Joe hands me his money, and I ultimately pay his claim. And because I'm good at this, I actually make money on the money that he's given me. And then on top of that, I earn an investment return while I'm waiting to pay his claim. And so that's what's incredibly attractive about the insurance industry. That's what keeps it fragmented. That's what keeps people sort of wanting to be in that industry. And it's just an incredible, powerful driver of returns. It's probably why Buffett loves the business. And if you're disciplined, and Arch is one of the disciplined companies, you know, that's what drives the returns. Now, there's one more piece to the puzzle, which gets to what we do, right? And it's that last component, which is the magic behind value investing, buying company at a serious discount to what it's truly worth, and watching that multiple evolve over time. That you know, turns a mundane insurance company investment into, you know, what Charlie Munger used to call a Lollapalooza. So who's next? So yes. Please.
Okay, I'm going to take us through Unilever, which is the newest member of our top 10 holdings. David mentioned we have Liquid IV here, which is one of their products.
And we have our Magnum ice cream bars here. Joe, will you take one and pass them down, please?
Yeah,
These are delicious, by the way. We think everyone should have one. Ian, try not to get it on your shirt this time. Thank you.
All right, so Unilever is maybe a little bit more tangible than sort of the story on Samsung or even Arch, because it's a fast-moving consumer good company, and it's one of the largest ones in the world. It's headquartered in London, but it's truly a global company with sales in 190 countries around the world. The current market cap is roughly $140 billion, which, as I learned this morning, is roughly the market cap added by NVIDIA this morning. So kind of an interesting fact, because I'm going to tell you next that this company is over 100 years old. And since its founding, it's really built its array of brands, products, and presence throughout the world.
Good brands.
Over 100-year brands. And so today, it's really a global powerhouse. Our history with Unilever doesn't quite go back that 100 years, but it does go back pretty far. We first bought shares in 2003 and exited that first successful investment in 2017. Our second and most recent investment was made last year at a price below where we sold in 2017. So the price is actually down over the 6 years since we sold it. So bear with me, I'm going to give you some statistics on what Unilever is today. Starting at the very top, roughly 3.4 billion people around the world use Unilever products every day. On a product basis, it has two main categories of business: home care and personal care, and foods, as you can see, one of those being ice cream. Beneath those main categories, they operate in beauty and well-being, which is roughly 21% of sales and 24% of operating profit. Major brands you'd recognize here are Dove and Vaseline. Personal care, 23% of sales and 28% of operating profit. Deodorants is a big piece, where Axe is a brand you might recognize. Home care, 21% of sales and 15% of operating profit. This is largely an emerging markets business, where laundry detergent is the biggest piece. Nutrition, 22% of sales and 25% of operating profit. You'd recognize Hellmann's as a big brand here, but also Knorr, which is a cooking aids business. And finally, ice cream, where I was going to say Ben & Jerry's would be the name that you would recognize the most, but maybe Magnum also now. So if you're paying attention to those revenue and profit splits, you'd realize that the beauty and well-being, personal care, nutrition, all are higher margins, roughly in the high teens, whereas home care and ice cream are lower margins, roughly in the low teens. And the total business has a margin around 17%. So across the business, they have dominant brands, with 30 large brands making up 75% of sales. And they also have leading market shares with number 1 or number 2 positions across roughly 80% of the business. Current revenue split by geography is 40% developed markets and 60% emerging markets. And this is a key positive benefit to these large global companies, because they not only have dominant brands in developed markets, but in emerging markets where per capita consumption is lower and the opportunities for growth are much higher. So what makes Unilever a good business? You've heard Joe mention and David mention, one of the hallmarks of a great business is the ability to generate high returns on the capital employed in the business. Today, Unilever earns a 16.5% return on that capital employed, and has averaged roughly 16% over the last 5 years. 16% is a healthy return, but what makes Unilever really unique is their ability to continue to allocate large amounts of capital in the business while continuing to earn high levels or even increasing levels on that return. It's the ability to earn high returns on incremental capital over long periods of time that creates large amounts of shareholder wealth. And what ultimately affords them to be able to do this is those brands that I spoke about, not only the existing ones, but having the machine to create new ones. A globally diversified business that operates in things like home care and personal care is one of the most stable businesses you can invest in. But despite that, all businesses face unforeseen events that could interrupt that long-term compounding if they're not operated in a financially conservative way. So Unilever has a strong financial position with the current net debt to EBITDA of roughly 2 times. So why have we been able to buy this high-quality business at a price that we think is attractive? Well, there are a few main things going on at Unilever. The first is a lack of growth. Despite the strengths I've described, growth has been anemic and slowing over the time period leading up to the pandemic. Underlying sales growth has averaged just 3%, with volume growth less than 2%. With its large emerging markets footprint, growth has been weighed towards emerging markets where currency depreciation hasn't resulted in real growth to investors like us in hard currencies like the US dollars. In essence, sales growth in US dollars was much lower than reported organic growth. Profitability was doing better than revenue as margins reached a high of 19% in 2019, only to fall to that 16.7% last year. A rapid increase in costs since the pandemic has led to pricing lagging costs and even lower volume levels, both leading to lower margins. The result has been a stagnant operating profit since 2017 to match the declining share price. So why has the company underperformed? In our opinion, there are two main reasons. Number one, the company simply did too many things, whether that was too many brands, SKUs, or more broadly, whole categories. Number two, the board and the management team did not properly manage the business. At the most extreme ends of the spectrum, Unilever sells beauty products, which are more like luxury goods, and at the other end of the spectrum, they sell local food products that are far more commoditized. Competition is far higher at the lower end, including competing with local brands and private label brands on the food side. Managing those local brands versus managing high-end personal care requires very different strategies. It's our belief that Unilever simply did too much and not enough things well. Mismanagement, doing too many things, losing market share, slowing volume, and declining margins are all signs of a company not being managed correctly despite the great brands and market positions I spoke about. So we're not the only ones to recognize the opportunity for better performance at Unilever. In 2017, you'll remember US company Kraft Heinz recognized the potential and made a bid to buy all the company at roughly $50. Management quickly rejected the bid on the grounds that Kraft would just cut costs and destroy the long-term health of the business by not investing in the brands. Soon after rejecting the bid, the company came out with a 20% margin target, which was gradually rescinded over time. So since the Kraft bid, the share price has stagnated as a reaction to the slowing growth and margins. They have rightly been exiting some of the more commoditized, lower growth, least attractive pieces of the business, including their spreads business. Slimming down the portfolio is the right strategy, but doing it in a way that creates the most value for shareholders is what good management teams do. Selling assets at seemingly high multiples only to see the buyers of those assets reach much higher levels of profitability is not maximizing shareholder value. So why are things changing now? The final straw on the journey to do too many things was Unilever's 2021 bid to buy Glaxo's consumer business, now publicly traded and called Haleon. For a business that was underperforming its own potential, to engage in a very large and complicated transaction was simply too much. This rightly caused pushback from existing shareholders, and management walked away from the deal at a higher price. At that time, it became clear to us that Unilever management had gone too far, and the company would be getting a new management team and changes at the board of directors level. After the failed transaction, Unilever named a new chairman, CEO, and CFO. The chairman is someone we have known from previous investments and has a proven track record of acting in shareholder interest to create value. Our conversations with the board and the new management team have all shown a clear plan and the ability to take decisive action to drive growth, profits, and return for shareholders. The new management team is moving fast to create the most value they can out of the existing business. The first step in that process was restoring the gross margin through pricing, volume growth, and cost efficiencies. And it's that gross margin improvement that funds the business, which eventually leads to higher growth. They've also recently made a major move in announcing the separation of the ice cream business through a demerger or a spinoff. This is an important move to significantly reduce the complexity of the business, and we think this demerger is only the first step to further simplifying the organization. That brings us finally to valuation. At the current price, Unilever is trading at roughly 15 times our estimate of earnings in 2026. And by 2026, the new management team will have demerged ice cream, most likely continue to further simplify the business, and restored competitiveness to the business. We estimate the company will be able to grow the top line by 5 to 6%, with operating leverage driving operating profit and EPS at a higher rate. Post the transformation, we see no reason why Unilever can't continue to allocate capital at high returns and compound value for shareholders for many years to come.
Great. Thank you, Ian. Charlie, we only have 43 minutes left, so, and I'm going to skip Novartis because we want to give people time for questions. So if you got a couple paragraphs that are extraneous in there, I would cross those out.
I'll drink some more coffee too.
Okay, great. Thank you.
I think David likes me because I keep Danone's cold brew sales afloat and I eat the stage props. But I'm happy to talk to you about our investment in ABB, which dates back to September 2014. To overly simplify, ABB is a global collection of electrical, motion, and automation-related businesses. Think the likes of electrical panels, distribution equipment, electric motors, robotics, and their controls. Today, it's got about a $99 billion market cap, great balance sheet, generates about $32 billion a year in revenue, and about $4 billion a year in free cash flow. About 60% of revenue comes from Europe or the United States, about 15% from China. They report 4 operating segments, with 17 or 18 business units under that. I'll spare you the gory details, but know this. Historically, they've had great products, quality, performance, and efficiency, and services around them. Most business units are top players in their respective markets. The company's history traces back over a century to 2 legacy businesses that merged in 1988. Before and after, they also made numerous acquisitions that took them into related and plenty of unrelated businesses. Over time, the company had evolved into a sprawling conglomerate doing everything from garage door openers to key parts of ship propulsion systems to massive power transmission projects. I think we even found that they were selling bags of clay and office furniture. However, we've gradually seen focus return over our holding period, which is not a coincidence. At one point, ABB was known as the GE, or General Electric of Europe. Funny enough, in 2018, they bought one of Thomas Edison's original businesses from the real General Electric, the Electrification Solutions business. So actually, as they today sell GE branded electrical equipment in the United States, they're arguably the GE of the United States. So if you're redoing your house or on the local co-op board, please keep that in mind. Thinking about our criteria, business quality, balance sheet, valuation, and management, I'll start with business quality. Much of this is an assembly business. You don't have to invest a lot in big, heavy assets. You don't need a lot of furnaces, foundries, or fancy real estate to make or sell your products. It should be and is pretty capital efficient. You buy parts and wires, bender machines and metal, stick them together, and get them out to the customers as quickly as possible. The secret to success is in the design, quality, reliability, and customer service for what you offer. When you do it right, you get pricing power. You can charge more than the next guy, and ABB is generally doing it right. Because of this efficiency, the business has generated an ability to generate great returns. Today, ABB is generating returns north of 20% on capital. In the decade before we got involved, it was well over 20%. From 2012 to 2022, it was below 20%, on the decline until 2019, and it's been recovering. Growth for a reasonably diversified industrial business should be at least as good as the economy as a base case, but really a market leader should be able to raise prices, create more value for shareholders, and benefit from increased market share as more customers and more companies are looking for their products. In other words, growth should be better. However, with the electrification of everything out there and the focus on energy and efficiency, we've been pretty lucky because ABB is really in the sweet spot, and that's something that's become much more apparent in the past couple of years. On the balance sheet, it's very good. It's investment grade, but if I tell David it's investment grade, he'll tell me to use my head. I guess the way I think about it, they can pay off all of their net debt in about 6 or 7 months and be free and clear. So in my book, that's pretty good. As to management and valuation, these are pretty intertwined here as we look back. I think ABB has proved to have some great businesses, but hindsight informs us that when we got involved in it, management at the time was not excellent. We knew earlier management had been poor, but the guy that was relatively new in the role had been promoted up. He was saying and doing the right things. But weak management meant shares were not as cheap as we initially thought. We thought we saw 30 to 50% upside to fair value based on peers and depending on how much went right. Margins were around 11%. We thought we could see 3 to 4 points of margin expansion. Unfortunately, during our initial years of ownership, reported margins actually compressed 3 to 4 points, but shares mostly traded water or marginally better, which I think highlights the importance of valuation in the buy decision. I think opportunity cost was our major problem in the initial years. We weren't worried about impairment of all of our capital. All that being said, we're not market timers. We care about price. We're patient. And the next CEO that would arrive on the scene in 2020 really has worked wonders. So looking back, shares have actually compounded about 13% annually since we got in nearly 10 years ago. Most of the outperformance has come in the past 4 or 5 years. We've gotten our margin expansion and then some, compared to an 11% operating margin when we got in. We see a current underlying earnings capacity around 18% margins, nearly 2/3 higher than before. I'll touch briefly on how did we get involved and start a position. Back in 2014, I think we saw 2 issues, a business issue and a management issue. One of the business issues was that they had gotten involved in what we consider engineering and construction type work. When done right, you can generate decent returns, even if margins are not great. Well, I think I've come around to Ian's view that these businesses are like chasing pennies in front of a steamroller. Severe consequences if management misreads the situation. It's too easy to misjudge a highly complex project with lots of moving pieces to throw you off schedule or budget. This work is surrounded by seas of banana peels. Most of this work could be found in their power systems business. An example might be delivering offshore wind infrastructure or a power station in a distant land with dodgy regulators. They might be delivering a new automotive assembly line. So this was about 20% of the business. It was losing money when we got in. Historically, it had mid-single-digit operating margins. We thought getting back to historical was good enough. We really didn't need best in class. On the management issue, I think this manifested itself in the declining returns on capital. 2 examples that sort of highlight some of the problems. First, in the aforementioned engineering and construction business, this tends to be a volatile business that nobody really likes. In theory, this was a delivery mechanism for ABB product. In reality, they were not dogmatic. They were willing to do projects where ABB product was less than 1/3 of what they were installing. The other issue is they were paying too much for acquisitions. They bought some really good businesses, but they paid really high prices for them. They weren't getting the cost savings or the synergies promised that might justify the prices they paid. But lo and behold, in 2013, about a year prior to our investment, they promoted in this new CEO, and we were encouraged. We thought it was a pretty good setup for success. Well, saying the right things and doing the right things are not always the same thing. Results remained not so good. Margins and returns were shrinking. We got more involved. Behind the scenes, we engaged with the board. We wrote letters. We connected with a large shareholder known for activism. We dug more deeply into the business. And honestly, we were surprised to find the underlying business should really be doing much better than we had originally thought possible. We came to see the CEO was not up for the task at hand and wanted new blood. Going back to our letters, we were arguing for focus. We thought ABB also was doing too much, and there should be separate businesses. The big power business with lots of heavy metal, low margins, and the bespoke power plant projects was an easy target. In December 2018, ABB announced the sale of this power grid business to Hitachi. A big burden was on the way out. In April 2019, the then CEO resigned, the chairman stepped in, and an interim CEO started a new search. But boy, they found a real winner in Bjorn Rosengren, who started on March 1st, 2020. We knew him from his track record of success at a prior public business, and I'm very sorry to say that he will be retiring within a few months. What's fundamentally changed and why? Well, for starters, they're out of the engineering and construction business, and the portfolio has much more focus. I think Bjorn has made a huge difference. I credit him with a huge step change in what ABB has become. This highlights the importance of business quality. A good business can often endure a poor management team for some time. ABB can also be seen as a case in organizational structure and incentives. In my first conversation with Bjorn as CEO, he said something that really struck with me. Never has he seen something so detrimental to accountability as a matrix structure. Nobody truly understands who's accountable, and there's always somebody else to blame. Blame can only fall on the CEO, which ironically may have been the downfall of his predecessor. Transparency, internal and external. If you cannot hide, you can be held accountable. And clear accountability paired with risk and reward can bring forth a remarkable clarity and sense of purpose throughout an organization. As Bjorn saw it, he had 17 businesses that he wanted each one to be led by somebody with their career on the line. Reward for success and consequences for the lack thereof. Line managers now have authority to make decisions and control expenses. Issues do not need to work through a bureaucratic chain of command where the outcome may be like the classic kids' game of telephone. They've put in place a benchmarking and management scorecard type of system that should well outlast Bjorn. But it's really pretty basic, simple stuff, but incredibly powerful. Transparency, authority, and accountability. So in closing, I would just like to say that when a great business and valuation align with a good management team, the outcome can be absolutely exceptional.
Thank you, Charlie. Well done. I would point out, and Ian didn't mention this, but we have the same teardown of the matrix structure inside of Unilever that we had inside of ABB, and focus and accountability are brought to the forefront. Part of that is driven by another board member that Ian didn't mention by the name of Nelson Peltz, who executed a similar change in strategy at Procter & Gamble in the United States to great success post that effort. But I guess the insight there is we learn from what one company has done successfully, and when we see it being done at another company, it makes us curious and makes us willing to dig in to look for that level of success. Because as Charlie said, the margins today at 18% were well above what we thought was realistically possible when we first got involved. Okay, so if I haven't scared all of you away from telling your children to be securities analysts, because it's incredibly detailed and boring, we've left 30 minutes for Q&A, and we're here to answer any questions you may have.
Thank you so much. We are not investor in the product, but this presentation is really intriguing. One thing I'm trying to understand, though, excellent analysis, no questioning, but the takeaway from the last two examples, are you eyeing more towards deeper value activism, early engagement, and we are not provided the timeline of engagement with the Unilever story? So I understand you're true value investors, but I want my smell and scratch test on that one.
Yeah. So the question is, are we getting involved earlier than historically? And the answer is no. When we go into any investment, and ABB is a good example, we thought that the new CEO was an upgrade relative to the people that we had running the business prior to Spiesshofer's involvement. And so we thought we had the right person. Now, interestingly, as we have grown in asset scale, we become larger and larger shareholders of the companies that we own. And you have a question in front of you that's meaningful when things aren't going the way that you thought they were going to go. So in the old days, when we were managing small pools of capital, it was pretty easy to cut and run and move on to something else, and we don't incur that opportunity cost that Charlie had mentioned earlier. But selling $1 billion worth of stock and then buying $1 billion worth of new stock is a serious effort, and finding the right thing to replace that capital is very difficult, because we engage in what I call needle in the haystack investing. And so if you have the ability to affect change And it's not going to be too costly in terms of time to affect that change. It's probably worth the effort. And in the case of ABB, as Charlie mentioned, we did engage. In the case of Unilever, somebody else is doing it. Nelson Peltz is doing it, and so we're very happy to ride on those coattails and let them do the heavy lifting. And we were able to identify, partially because of our experience with ABB and other companies from that Scandinavian group of companies that have done this very successfully over many years, that structure is likely to work. Ian, you have anything to add to that?
No, I mean, I think what we'd want to make clear is that we're trying to find great management teams and great businesses, right? We don't go into investments thinking this is a terrible management team that we want to change. That's a very laborious process. We went through that with Danone, where we were one of the leaders of revamping management, and that takes a long time. A, to get the management team out, B, to bring someone in, C, to redo the strategy. And damage can be done during that process. So it's not something that we're reluctant to do when we see great assets being mismanaged, but we'd much rather have, like in the case of Unilever, buying into the company when they've already put in a new management team and a board structure that can drive value.
Ed, you want to? Everybody, that's Ed Omada in our distribution platform. Yep. He's going to take a question that came in online.
Yeah, we've got a bunch of pre-submitted questions and online questions, so apologies. We're probably not going to get to all of them, but got a number of questions on Samsung, Joe, so I'll direct these to you. I'll try to summarize them as best as possible, but you alluded to kind of Samsung's businesses, the various business lines, and to what extent they potentially benefit from sort of the AI revolution, memory being the most obvious, but can you speak to maybe some others? And then along those lines, you also alluded to potentially there's been a lot of press recently about maybe losing some of that leadership to Hynix. What gives you the confidence they're going to get it back?
So I think the memory business definitely obviously benefits from AI. The foundry business also benefits from AI because AI requires leading edge chips that are highly complex to manufacture. And I mentioned before, there are only two companies in the world that can do that, TSMC and Samsung. So it's basically the components business that benefits from AI, but also the mobile business, because Samsung is vertically integrated, and with AI, you're going to have AI phones, you're going to have AI PCs, and what that drives is higher memory content per device. So because of those end devices, Samsung sells some of them and doesn't sell some of them, but the device segment also benefits from greater data requirements. In terms of confidence, you might not know this, but the guys who actually built HBM at Hynix came from Samsung. That team came from Samsung. And they left Samsung 6 years ago because of the cultural issues that I mentioned, where they weren't given the freedom to pursue what they felt was a good approach to solving the problem. So the way that semiconductor manufacturing works and product design roadmaps work is you can't catch up immediately. If you have to catch up, it takes 2 to 3 years. And so we're in the midst of that process. And what gives us confidence is just Samsung's long track record, its scale. I mentioned CapEx and R&D, and they have a deep bench. The new CEO that they have installed has a track record of success. So the combination of those things gives us confidence in their competitive ability.
So, and we don't need it. right? You know, we're bouncing off of the bottom of a cycle, and when we look at the normalized, you know, profit stream of this cycle, we don't consider the dynamic associated with AI in our estimate of what we think that they can earn in a normalized cycle. And AI is cream on top, so to speak. Now, if you really want to get bullish on this, you know, you could call this the cycle of all cycles for Samsung, because not only are you coming off of a terrible downturn and headed towards some normalized level of profits, but you also have this incremental demand driven by AI in the core memory business. You also, so the way this works is, I don't know, does anybody have a phone? When you use your phone, when you use your phone to process AI driven applications, it's very, what happens is the information goes out to a server and the server brings it back. And once you start getting, you know, past standard text, which we all see with ChatGPT and other applications like that, and you start to get to things like video and images, it will leave and it will come back 30 seconds or a minute later, which tells you how much processing power is being used. And eventually some of that processing, it can't be handled in the cloud. It has to be handled on the device. And so if we get killer apps, so to speak, that everybody is going to want to have, they're going to have a new device. So Samsung will sell, you know, the standard memory into the areas that they've been selling it to historically. They incrementally could get demand for servers that are need to process AI applications. They will sell more memory into handsets. They will sell more memory into computers, and then they will sell more handsets. We'll have a complete replacement cycle. All of us will have a new Apple phone or a new Android phone. And of course, Samsung has 22% market share in phones, and all of those phones and all those computers need new displays, right? So if all the chips head in the direction that NVIDIA's market cap implies today, if the collective stock market about NVIDIA is correct, then we should have the cycle of all cycles that should benefit Samsung. All of that at 6 times EBIT.
Yeah, and that, like David alluded to, that's not contemplating this AI cycle. That's going back and actually looking at historical levels of profitability. So we don't want to underwrite the AI cycle. If we get it, it's great. Yeah.
We're a ridiculously conservative group of people when we make our asset allocation decisions.
So Dan O'Keefe mentioned yesterday that has seen less and less value in in-person visits, and that it convolutes kind of the objectivity that he's looking for. And then David, you mentioned that, you know, you get to know your companies and you analyze the data yourselves. But have you seen, how do you analyze that? Like, do you see less and less value in in-person visits, or kind of how's your view changed on that compared to the global team and the international team?
Well, and this may be, you know, a finer point, but I think what Dan was talking about is sort of a controlled visit. If you have a relationship with a human being, your dialogue, without getting material non-public information, cascades in a different way than the dialogue would cascade if somebody's got a pitch book in front of you and is just talking off of the pitch book. And I believe, and we can ask Dan if he's here, I believe that's what he was alluding to. You go to these meetings and you get force-fed basic information that you can largely find out by reading a transcript or looking at a pitch book. If you're having an in-depth dialogue with Ian Meakins, who's the chairman of Unilever, that we have known for the last 20 years because he was an operating executive at a company that we were heavily invested in, because he was the chairman of the board of another company that we've owned for decades, where he's helped us work through some issues on that company. You have a relationship and you have a dialogue with that person that is unlikely to be canned. Again, we're not searching material non-public information, but insights into human beings, insights into strategies, insights into competitors that are dialogues that are time-consuming, and they don't have time to have that sort of dialogue with everyone. And if you have that sort of relationship, then you can have a meaningful conversation, with an executive that's helpful.
Just adding a little bit to that, the initial interaction with a management team could be very canned, but it's the start of building that relationship over time that leads to not only them knowing that we do our homework, we can actually add value to the conversation, but building up a relationship over time that becomes a much more developed conversation. And we develop these relationships over many years so that executives leave one company, go to another company, even retire. We're able to call on this network of people and have these sort of more evolved conversations, and we find it very useful.
Hi, thank you for your presentation. I'm over here at the back. You've mentioned a number of times that Samsung is one of the top semiconductor producers in the world. Obviously, TSMC is fundamentally the premier producer of those high-level 7-nanometer chips. Where do you see Samsung in that value scale of where do they have that competitive advantage in that chip production space? And then a kind of second lead-on question, if the worst case scenario was to happen and China invaded Taiwan, how quickly and how effectively could Samsung pick up that production of those higher-end chips, if at all?
In terms of competition with TSMC, remember that Samsung makes most of its money in its memory chip business, which TSMC is not in the memory chip business. TSMC is in the foundry business, which is effectively outsourced manufacturing for chip designers. Now, Samsung is the only other company in the world, aside from TSMC, that can actually manufacture chips at the leading edge of technology, which is a nice thing to say, but they haven't turned it into anywhere close to the economics that TSMC has turned it into. That business is growing. They are getting better at it. The profitability is okay, but the returns on that business to date have not been great. But let's just fast forward and dream the dream that Samsung gets it right, and Joe alluded to this a little bit. That business is, at least in recent decades, far less cyclical than memory. And if you generate a larger part of your profit pool from a business that's less cyclical, presumably the market would assign, and we would assign, we would think that the value of that business is far higher than the value of a business that has periods of time where the profits disappear. On your second question, do you have anything to add to that, Joe?
I'll just say that Samsung did struggle when it came from like 7 nanometer to 10 nanometer. I do believe that it was basically a manufacturing issue. It was a yield issue. But they now have their 4 nanometer process where they're achieving better outcomes. And it's still early, but the yields and performance is much better than their experience in the recent past.
And honestly, we wouldn't know how to handicap, the dynamics of the world if China invades Taiwan. I mean, that could be, the variability in those outcomes is absolutely enormous, and what the possibilities are. Providing some sort of forecast on what the world might look like after that happens would be unreasonable for me to try to attempt. Ian, do you want to talk about China invading Taiwan?
As Charlie Munger would say, I have nothing to add.
Okay, all right. Ed, you want to?
Yeah, next question. We had a question about inflation, which is obviously more of a macro topic, but asked specifically in the context of Unilever. So maybe, Ian, I'll throw it to you first, and then any of you other guys can weigh in with how you think about inflation in other businesses. But specifically with Unilever selling consumer goods, specifically premium branded, premium priced consumer goods into a consumer that's pressured by inflation, real disposable income being pressured, et cetera. What's been the impact on their business? And more importantly, I guess, how do you think about that going forward?
Yeah, I mean, I think I alluded to it a little bit in my quick presentation, which is a declining gross margin, which is essentially higher costs, raw materials that you can't pass the price through fast enough. It's fascinating to think that, if you have brands, you can not only, get that pricing eventually as sort of wages catch up with that, with the quick inflation in raw materials, but it's also forced management teams to dig a little deeper and find cost savings and cost efficiencies. And in the case of Unilever, look at where they can really drive it in the larger buckets and sort of get out of the smaller buckets. So it's a way of saying it's the gross margin that you can get back eventually. In Unilever's case, it was whatever it was, 46%, goes to, you lose 400 basis points, we get back to 46%. But when we do the analysis and look at the costs that are coming out, you're actually seeing improving gross margins because of this inflation. Now, it's very hard to do when you're at the low end and there's very little differentiation between the products. But when you do have these brands that are, people are willing to pay for, that's when you can actually see it as a benefit.
Inflation is very interesting, thing to think about. It impacts different businesses in different ways, and you'll know with Arch, as I mentioned earlier, as the price of your home goes up, the insurer is insuring more value, and as a result, the premium on that policy goes up. But we own shares in two contract catering companies, which basically sell food into cafeterias, and it drives their revenue because they're just passing on those costs to the ultimate consumer in those cafeterias, and where they have a cost advantage, it actually drives penetration and for outsourced catering, and so it impacts businesses in different ways. It's also sort of very interesting to think about it in sort of our own context, where we've all sort of come off of a long period of very low rates of inflation, an incredibly long period of low rates of inflation. And so, your natural tendency is to sort of anchor on that as normal. And we're living through a time period where, governments are, basically creating money by massive deficit spending across the globe. And, the market commentary, which is kind of fun to watch, is, inflation's going to end and interest rates are going to go down, and that could definitely happen. I don't know really what's going to happen, but it seems incongruous with, every government out there in the world creating more and more money every day. That money has to find its way into the system somewhere, in a world where, goods have finite capacity. It tends to generate inflation over time. So, maybe all this anchoring that we all do, and we're all hoping that inflation goes back to where it used to be, maybe that, could possibly be unrealistic, and we're going to be living with this for a long time. I wrote this sort of tongue-in-cheek little note in my last shareholder letter about building a wall in my backyard in San Francisco, and I think maybe reading through that and think about some of the things that are going on in the world today might give you a little bit of insight into the way that we think about inflation. Ian, do you want to comment on inflation generally?
No, I think I'd probably come back to more stock specific, whereas, you can say eventually will be a positive for some of the consumer goods companies. There are other companies where, there's been regulated pricing based on costs, where it's taken a long time to sort of pass that through the system, where it's been much more of a negative effect. So clearly not, positive across the board. It depends on the business model and being able to really pass through that inflationary impact in a quick way. It's not that those companies won't eventually get there. It's just a huge hit to profitability along the way.
We have a question from the crowd.
Question in the front. Thank you, panel, for your comments today. The details are much appreciated and not boring at all, so thank you. My question is about competition for capital in the portfolio amongst all these great ideas. The biggest position is Samsung, which it sounds like you have strong conviction in the internal capital compounding of that core business, but you also contrasted it with management activism, multiple upside levers, shareholder reduction in other names that were mentioned today that you may not necessarily get in a market like Korea. So help us unpack a little bit how you size and prioritize those ideas in the portfolio. Thanks.
Yeah, we didn't bring a slide associated with portfolio construction, but it's pretty simple. We allocate capital based on expected return. So simply, if we had two securities in the portfolio and we thought one might bring us a 50% return at a fair price, and another one might bring us a 30% return at a fair price, we'll allocate more capital, all else equal, liquidity inputs and all those sorts of things, based on that expected return. You mentioned, interestingly, that our conviction on compounding for Samsung, but remember that there's two components to that capital allocation decision. There's not only the conviction that this is a good business and it should be more valuable in the future than it is today, but we're also not paying a fair price for that. And that valuation that Joe talked about is absurdly cheap. If you think about one of the 5 best recognized brands in the world, one of the largest technology companies in the world, and you can buy that at effectively less than 10 times earnings with no debt on the balance sheet, it just seems absurdly cheap for the type of business that it is. Now, we laid out all the issues, right? We talked about the corporate governance issues. J.Y. Lee's been in and out of jail. It's very interesting to sort of internalize the scale of this operation inside a relatively small country in Korea, right? If you start a company like this in the United States, you have 320 million rich people, big consumers, big companies that you can sell to, and a lot of your customers are culturally the same. We struggle to communicate with the senior leadership at Samsung. They barely speak English. And to think of a group of engineers in a small country like that able to create a company of that scale and of that size and that dominance in their industry, they're spending $45 billion a year on capital spending. That's an enormous number, and their competitors can't get enough capital to keep up with them. They just can't, despite being located in, and at least one of them, Micron, in the United States, where they should have easier access to capital. It's just an absolutely, if you internalize what has been constructed there, it is absolutely amazing, and you can buy it at that sort of price with no financial risk. It's just incredibly compelling in our view. But to answer your basic question, the competition for capital in the portfolio really comes down to our risk-adjusted assessments of what we think that company is worth relative to where the share price is trading. Ian, do you want to?
No, other than I warned Charlie that talking about ABB was going to be the one that was most difficult to get questions on. So anybody have any ABB-related questions for Charlie, that would be great.
Yeah, since we've got the team up there, we did have a question on just team structure and why it's structured the way it is. I think most people in the audience are more familiar with sort of the industry sector specialist model. You've intentionally gone the other way with the generalist model. So I guess this is open to any one of you guys, but why is that a better coverage model for what we do versus, again, the more specialist model that you traditionally see?
Well, what's really fascinating about this is, any one of us could, be the hammer on any one of these equities. It takes a long time to train and to build the cumulative knowledge to be able to look at companies that operate in multiple industries, in multiple countries with multiple different corporate governance and cultural structures. And it creates a very powerful investor. And I guess that's the difference between what we're doing here is we're building investors. And we're not building analysts. We're building people who understand, what are the risk-reward factors that you have in front of you? How do these businesses operate? And how can I generate returns in any part of the world and in any industry? So if I get hit by a bus tomorrow, we're constantly asked about succession. It doesn't really matter. Any one of us up here at this table has been trained well enough and is well equipped enough to understand all the businesses in the portfolio, what they do and how they operate. And because our capital allocation system is not incredibly complicated, they have a good enough guideline for them to be able to figure out where to put the money. So those are the reasons why we do it. It makes a lot more sense to us than having somebody that knows a lot about media but doesn't really know a lot about anything else. That's only a partially useful. It does allow you to employ a lot of analysts, but that in my mind just creates confusion. So we do it because it makes sense. Looks like there's a question over here.
Yeah, for ABB, what's your view on the CEO search and succession process? Thank you.
I'll just say the guy that's replacing him, he's already been announced. Morten Wierod has been an excellent manager among several of the major business units or segments within ABB, and he's done a great job. He's a relatively young guy. He, I think, will be able to stay in the role and maintain continuity of what Bjorn has accomplished. And I don't expect to see much change.
We like, as more of a little bit more of a backdrop, we like the people who are on this board of directors. We think that they're very performance oriented, and hopefully that mitigates a lot of the dysfunction associated with selecting CEOs, and we've got the right person. Ed?
Well, you had to skip over Novartis for the sake of time, but we did get a question on Novartis, so maybe this is a chance to talk about it a little bit. The question does mention a lot of the talk in pharma has been about GLP-1s, which maybe you can offer some general thoughts on that. But then when you're analyzing Novartis, or I guess any pharma company, how do you go about valuing that pipeline? Putting a value on the current pipeline, the future pipeline, how do you think about what that's worth?
Well, that's a very good question. It's a complicated question. Generally speaking, when we get involved with pharmaceutical companies, there's a certain amount of productivity that comes out of R&D spend. Sometimes it's terrible, and sometimes it's very good, and you can sort of look at the historical averages. And so we want to get involved with a pharmaceutical company when the productivity looks terrible, and the market cap reflects that. Novo Nordisk is on the opposite side of that spectrum. The market cap, none of these companies really have debt, but Novo Nordisk's market cap is $600 billion, and they've got $50 billion in revenue. And Novartis's market cap is $230 billion, and they got $50 billion in revenue. Roche, another big pharmaceutical company out there, has a $186 billion market cap and has $65 billion in revenue. And so if you're sort of looking at the averages, who's super productive at this point, it's Novo Nordisk, which has one of these GLP-1s. And remember that one of the remarkable things about the pharmaceutical industry is that you have a certain decline, right? This is a patent-driven business, so with certainty when your profits are going to go away, and you have significant uncertainty as when those profits are going to be replaced, because that depends on the productivity of your pipeline. So, and I'm not saying, without making any commentary on, the attractiveness or unattractiveness of Novo Nordisk and its ability, the share price to go up or down, it just doesn't fit the profile of what we would look for in an industry where it's very, very hard to handicap, what generally speaking is coming out of the pipeline. You spent a lot of time with Roshi, and what are your thoughts on this?
I think to the question of how do you value the pipeline, it's certainly very difficult. Whether it's a phase 1 asset or phase 2 asset or phase 3 assets, they generally have different levels of probability. But when we invest in pharma companies, we tend to look at them on the existing products in the market, right? If we can get the valuation that we want on the existing business, that gives us enough comfort to say, well, here's what we see in the pipeline. Here's the potential market for that. Here's the probability that that could. And we look at that as sort of upside to the case. But investing based on a phase 1 or phase 2 asset is too hard for us. But that's not to say that we can't invest in these businesses just based on the products that are in the market.
Well, this has been an incredibly fun and productive event for us. We thank you all for coming, and we look forward to seeing you all next year. Thank you.